Good afternoon. This is Joshua Walker at the Japan Society. Okay, actually, I'm not at Japan Society, but we are incredibly proud to be hosting this virtual event with Columbia and with all of you. Thank you for joining today on a Friday. It seems like days and weekdays and weekends have all merged together, but today's conversation about the role of central banks in COVID-19 couldn't be more timely, and I couldn't be more excited to get to the conversation that we're going to have today. My job is to simply thank you all for being here, but also to thank all of our sponsors who've made this possible, especially during this period of COVID. It's been impossible to do things, and we can't do our work without them. So first and foremost, thank you to our global leaders, Citi and Deloitte, our corporate partners, Mizuho, Toyota, and United Airlines, and then of course to our co-organizers, the Center on Japanese Economy and Business at Columbia Business School and Apex Studies Center at Columbia University. Without further ado, let me turn this over to Professor Ito, who's the Director of Programs of Public Pension and Sovereign Funds, who's known to all of us in the Japanese space. Ito-sensei, thank you for joining us.
Thank you. Good afternoon, everyone. My name is Patricia Ito, and Director on the Program Public Pension and Sovereign Funds at the CJEB, Columbia University. And I'm also teaching at the School of International and Public Affairs, Columbia University. And on behalf of the CJEB, I'd like to give the welcome on behalf of the David Weinstein, who's on leave, and Hugh Patrick, who's the founder of the CJEB, who cannot join this time. So I truly appreciate your joining us today, despite this challenging time we are all facing due to the pandemic. Before we begin, I'd like to take a moment to thank all the CJEB sponsors for their generous donations and support, especially in the face of this current crisis. And about the topic of discussion, I think it's very timely and important that we have all seen the responses of the major central banks this week. And we hear from the two experts who are best to explain to us what is going on in Washington, Tokyo, and beyond. And I'm really looking forward to learning all about central banks responding to the pandemic this week and beyond. Thank you very much, and back to you, Josh.
All right, thank you so much, Ito-sensei. Let's get right to the conversation. As we said, this is a timely topic. We couldn't have a better panel here, and we have a great moderator who's going to lead us through this. Kathleen Hayes is a global economic and policy editor at Bloomberg Television and Radio. Kathleen, over to you. Thank you again.
Well, thank you so much. I want to say hello to everyone. Thank you for joining us today. And of course, not only what better panelists, what better organization to sponsor and hold this event, but what a great week. The week kicked off with the Bank of Japan making a decision, making a big policy announcement, followed up by the Federal Reserve and topping it off with the European Central Bank. It could not have been timed better to look at how central banks actually in many ways paralleling each other, echoing each other in how they're dealing with this pandemic, how they're dealing with what has become a global crisis. We are going to be hearing now from Koji Nakamura. He is the General Manager of the Americas for the Bank of Japan. Great to have him here. Patricia Moster, School of International Public Affairs, Columbia University. She was at the Office of Financial Research Analysis at Treasury for many years, 20 years at the New York Fed, and she was, of course, on the open markets desk, a senior economist, senior manager. So two people very well positioned to look at what we are seeing so far and what central banks will, can, and maybe even must do next. So Nakamura-san, why don't you start? Again, BOJ met on Monday, some big announcements. I think a lot of people wonder what kind of impact they'll have and just what they mean.
Mm-hmm. Okay, thank you very much for having me. It's my great pleasure to discuss important issues at a critical juncture with distinguished participants today. Before my presentation, I have two remarks. First, it's a usual central banker's disclaimer. Views here are mine and do not necessarily reflect those of Bank of Japan. The second, my background is a picture of Kamikoji, Japan Alps National Park, where I was branch manager in the region 2 years ago. And I wish I could be there, but I'm locked down in New York for sure. So let me start my presentation. At the beginning of this year, almost nobody expected that coronavirus pandemic put the global economy into a crisis. Since the global financial market started to react to the spreads of the coronavirus late February, the central banks around the globe have provided emergency measures very swiftly. Thanks to the painful experiences of the global financial crisis, central banks are well prepared to act against market turmoil and expand or reactivate emergency measures. Let me use my slides. Can you see that? Okay. This slide shows the central bank's policy measures. There are different taxonomies of unconventional monetary policy measures. Here I categorize 4: liquidity provision, interest rates and forward guidance, asset purchases, and lending programs and facilities. As for the BOJ's case, for liquidity provision, we have engaged in active market operations and US dollar funding operations backed by the swap lines with the Federal Reserve. Regarding the interest rates and forward guidance, we maintained yield curve control, keeping short-term interest rates minus 0.1% and long-term interest rate of 0%. And also we have several forward guidance. Regarding asset purchases, we purchased various assets even before the coronavirus outbreak. And this time we increased the amount of purchases of assets, including JGBs, CPs, and the corporate bonds, EDFs, and the JREITs. On lending program, we have several existing lending programs, and this time we introduced a new COVID-19 special fund supply operations in March, and then in April, we announced that we would introduce a new fund provision measures for SME financing in near future. By these measures, we have mainly 3 goals. First, stabilizing financial markets. Second, supporting corporate and household financing. Third, stimulating the economy. At the initial phase of the crisis, we saw huge market volatilities and investors tried to secure cash at hand and sell risky assets. Even US government bonds were sold. At this juncture, stabilizing financial markets is essential, and the central bank should act as a market maker of last resort. Then, due to the social distancing measures, the entire economy shut down. On this occasion, central banks working together with the government should provide support for corporate and household financing. Asset purchases and lending programs are effective. Then we also needed to stimulate the economy. Low and stable interest rate environment is essential, especially after social distance measures are lifted in order to bring the economy back to the normal level. This is a slide of the central bank's balance sheet. As a result of these measures, central bank's balance sheets are expanding rapidly since March. As you can see, the right-hand side of the chart. The BOJ has implemented various unconventional monetary policy measures even before the coronavirus outbreak in order to bring the inflation back to the target level of 2%, so that the balance sheet size of the BOJ in comparison with the size of the economy is much larger, as you can see. This slide shows the latest forecast of the GDP and the CPI by the BOJ board members. For fiscal year of 2020, the GDP growth is from -5% to -3%. For fiscal year 2021, GDP growth becomes robust due to the pent-up demand. The CPI inflation will be muted for a while due to the stagnant economy and low commodity prices, and then go up moderately. But there's a huge uncertainties and the downside risks are large. Let me stop here. Thank you.
Well, Mr. Nakamura, thank you very much for putting that on the table. I just have to interject that I love that chart. I use it on Bloomberg television all the time when you talk about central banks being aggressive and who's being most aggressive, because BOJ, if you look at the balance sheet as percent of GDP, clearly is very, very strong. So let's go to you now, Professor Mosser, taking a look at the Fed for us.
Certainly. Good afternoon, everyone. I'm going to share my screen here to put my slides up. I hope everyone can see that. So I'm going to pick up where Nakamura-san has started, but to shift over and talk about the US. And I completely agree with his description. In fact, my description of what's happened in the United States economy is that it stepped off a cliff in the middle of March, as this particular chart makes very clear. This is an index of weekly economic activity, so it uses high frequency weekly indicators, but it is scaled to match the year-over-year changes in US GDP. You can see the financial crisis on the far left, and you can see the stepping off the cliff on the right. The rate at which the US economy is contracted in the last 6 weeks is absolutely astonishing. And if it makes you a little scared, that's probably not such a bad thing. So the policy response on the other side, of course, in the US has been all at once. And when you have a real economy that collapsed that quickly, which almost never happens, policies need to act and act as quickly as they possibly can. I describe most of the policy changes, both fiscal and monetary, that have been undertaken to date or that are still in the planning stages, as cushion the blow policies. They are bridges to bridge until such time as the shutdowns can be eased, and hopefully that businesses can reopen and jobs can restart. This is talk about monetary, not fiscal policy, but I think it's interesting that fiscal policy in the United States does fit that mold. It's very focused on transfer payments, on guarantees, and on providing equity to companies. But this is about monetary policy, so let me talk in a little more detail about that. I call what the Federal Reserve has done is basically falling into three broad categories, similar to the categories that Koji used a moment ago. One is monetary policy. Immediately, the Federal Reserve cut the policy interest rate to zero, and they started using very aggressive forward guidance. They also embarked on a massive, and I mean massive, expansion in asset purchases. Part of that was because of the turmoil in financial markets, but part of it was also an easing of monetary policy using the usual unconventional tool. I want to point out just how massive this was. For the better part of a week in the middle of March, the Federal Reserve was buying as many securities in a day as they bought in a month, more, in fact, than they bought in any month during the financial crisis. By about next week, they will have bought as many securities in 6 or 7 weeks as they bought for both QE1 and QE2 combined. Absolutely extraordinarily large purchases. The other piece of this, of course, has been liquidity provision, lender of last resort expansions, expanding lending to the financial system. There, the take-up has been relatively small, not zero, but that's because the financial system was in pretty good shape walking into this crisis, which has actually been a bit of a source of strength. The other piece of this, of course, is international lender of last resort and the dollar swap lines. Those, in fact, have been the biggest parts of the Fed lending, something on the order of $400 billion so far. Last but not least, the Fed's actions have been about targeted credit facilities, meaning bridge financing, if you like, for firms and households and state and local governments. This is very much uncharted territory, or mostly uncharted territory for the Federal Reserve, and many of these programs are brand new and are being created from scratch. While these are very promising and have had some pretty big market confidence effects, what they haven't done, and for the most part, many of them are still on the drawing board. Now, we expect to see quite a few of them in the coming days and weeks to be implemented, but that part of the bridge, if you like, of the cushion the blow, is not quite in place in the U.S. Here's the Fed's balance sheet. Again, I pick March 11th as the last pre-crisis week, I guess. The Fed's balance sheet was $4.3 trillion. It is now $6.6 trillion. Nearly all of that, as I mentioned, are the securities purchases, with a smaller amount of it being the swap lines. So what happens next? Well, first of all, there's obviously huge macroeconomic uncertainty about how both when the shutdowns are going to end, the degree to which they can end, and how much recovery there will be even after shutdowns in the United States end. It's obvious we're having a very sharp and very deep recession. The recovery, I'm dubious about the V-shape myself. Someone I spoke to earlier today called it a Nike swoosh. Maybe that's a better description of where I think we might come out. But here's the risk. The longer the shutdown and the downturn last, then there is a much higher risk of very serious financial distress. And the banking and the financial system have been strong to this point. They're increasing their lending right now. If they are not able to continue to do that, then adding financial distress to an already weak economy could darken the economic outlook quite a bit. So the speed and the timing really depend on the virus itself, obviously, and the success and the ability of policies to actually bridge the gap. The global outlook obviously is grim. There's a lack of fiscal space in many countries. That is not a problem that fortunately Japan and the United States are facing right now, but it is in many countries. And as I mentioned earlier, the liquidity needs are very large. I think there are three major questions for central banks about the credit programs, about what they do next, and the question about central bank independence. A lot of these credit programs are quasi-fiscal, but I'm guessing those are things that Kathleen is going to ask, and the audience are going to ask us a bunch of questions about. So I will stop there.
All right. Well, thank you so much. And in fact, yeah, I think our audience questions that we've accumulated so far touch on a lot of really interesting, important, big issues, and you've certainly outlined several of them there. I want to start by looking at some of the specifics of the meetings this week. And so I want to go back to you, Nakamura-san. The BOJ, you mentioned some very specific steps, and anything that had to do with bond purchases was really front and center for markets, like increasing corporate bond purchases, increasing commercial paper purchases. But I think the unlimited government bond buying, people, okay, there it is, whatever it takes, that's a theme for the central banks. But at the same time, people pointed out that, the BOJ had already pulled back its purchases. What you can do, 80 trillion in a year. Over the past year through April, it was something like 14 trillion. So the capacity was already there to buy more bonds. And people are just wondering, and when that chart you showed, how big the balance sheet is relative to GDP, something like 110%. One common phrase I heard, but this was really more of a communication step, part of the communication strategy to tell the world BOJ is ready to do more, than it was actually announcing something that would be a big policy step. What do you think of that?
Well, regarding the JGB purchase, we just limited the wording of the 80 trillion yen, but this is the commitment that we can do whatever we needed. And we purchased the JGBs as long as I needed in order to keep the long-term interest rate as a 0%, because we moved to the YYC framework, yield curve control framework, a couple of years ago, and then keep the low interest rates for the time being. So this is the most important factor for any economic entities to get the money from the market. So stable long-term interest rates is a crucial factor. In order to attain the stable interest rate of long-term interest rates, then we needed to purchase the JGBs as needed. That's the framework. So then we're not sure, because of the market could be more volatile in the future due to the additional shocks. Then in that case, we might need to purchase more JGBs comparing with the low demand in the past several years. So limiting the 80 trillion yen might be a better idea to do more flexible of the options for the BOJ to conduct the monetary policy.
Could I just follow up on that? Because you mentioned, so is market volatility one of the things the BOJ would be watching to go ahead and take that step and step up the purchases?
Yeah. Well, liquidity condition is very important for the the government bond market, not only Japan, but also the United States. We saw the huge spikes in the US Treasury market in the mid-March due to the huge shocks, right? So even for the safe asset market, we could see the volatility. So in that case, nobody but the central bank could intervene in the market to stabilize the market. That's the first line of defense, and that's the market maker will last resort.
Okay. Well, Professor Moss, let's get to Jay Powell and his press conference, which is really where all the news came from, and many people considered it, great, masterful performance. But it was pretty clear. Basically, he said the Fed's ready to do more. Then he said more needs to be done by Fed, by Treasury. Some the Fed can do, some Treasury must do. Do you see specific gaps that the Fed needs to fill at this point, that the Treasury needs to fill? Do they need to do more?
I am afraid that everyone's going to have to do more. I am not convinced, as I mentioned earlier, I'm not big on a V-shaped recovery, which means if economic weakness and unemployment and particularly small and medium firm bankruptcies are going to continue, and I'm afraid they will, and those things are slow to start back up again. They don't just bounce right back. Then more on the fiscal side and potentially more on the monetary side may both be needed. So the short answer is yes. As for, and effectively, Chair Powell alluding several times in the press conference to we're planning, without specifics yet, but that's not a surprise, told you that they are thinking about what they could do next. In terms of near-term gaps, I think by far the most important thing that needs to get done is to get more of the credit programs, I would say particularly for the small and medium-sized business lending, up and running. Now, the lending parts of those programs, of course, are Federal Reserve lending, but very, very importantly, backstopped with U.S. government, with U.S. Treasury, with taxpayer equity that takes the first loss position. The Fed could not do that lending without that backstop from Treasury. It literally would not be legal. And that is actually an interesting contrast, I think, between the Fed and the BOJ. But it does have that backstop. But as a result, those programs and their design, and particularly how much capital is put into them, is actually a Treasury decision. It's not a Fed decision. The design is obviously both, since both agencies have a role in this, and that's where the heavy cooperation is required. But at this point, speed really matters. I wouldn't want the perfect to be the enemy of the good. And I'm pretty sure that they're perfectly well aware of that. I am, another place where I think more will almost certainly have to be done is on the municipal side. Now, fiscal risk sharing across the states is, well, fiscal. It's not monetary. And while the municipal lending program that the Federal Reserve will embark upon, I think is important. I think it's very appropriately tied directly to tax revenues, very short run and very narrow. Determining winners and losers among states and municipalities is inherently a political fiscal action, and that's a place where if you asked me that more might have to be done, particularly on the fiscal side, I would point there.
Okay. Well, a question I kind of want to put to both of you. So let's go back to the Bank of Japan. How about, how will you know, what are you watching? How do you know if and when you need to do more? I mean, you've got all these different things you're watching at once. You've got the inflation, you've got the growth, you've got, and in fact, in Japan, still, extending the lockdown recently, maybe at a somewhat different phase with that, but still so much being driven by the virus and what it does to the economy and how it all works out. So how will you know when you need to do more?
Well, it's true, and also Trish pointed out that it crucially depends on the duration of the lockdown, and economic condition is crucial depending on how long the lockdown will be. And now the financial sector is resilient and actually actively helping the economy right now. But as time goes by, and then we might have a more disastrous situation. And in that case, we need more in terms of the various policy measures, including monetary policy. So there's a huge uncertainties, and it crucially depends on how the things unfold in the future. So we will consider the possibility of various options and see what kind of policy measure that we use in the future if things are turning bad. But at this moment, we think we need to implement the existing measures, and that we also have the one lending program in pipeline for the SME financing. So we're now working on that and to provide more financing to the entire economy. That's the important things right now.
Okay, and what do you think for the Fed? How would you tell them, yes, guys, it's time to do more?
I completely agree with Koji that the financial distress, unfortunately, you will know it when you see it. And that's the point at which, in particular, perhaps more expansive, not in terms of size, but in terms of breadth, lending facilities might be needed by the Federal Reserve for the financial sector itself. The US is a market-based financial system, but most of the Fed's lending tools go through banks, and the extent to which they might have to even further broaden out lending if there were widespread financial distress, I think is worth considering. On the macro economy, at this point, my best estimate would be that there are a series of tools that have been used by other central banks, tools that have been discussed by governors in previous speeches that they must be looking at very carefully. I'm thinking of things like Governor Brainerd's speech last year, where she spoke about a slightly different version of yield curve control, but effectively medium-term reinforcing forward guidance by commitments to basically keep rates at zero for a certain way out the U.S. yield curve, certain portion of the way out there. Negative interest rates. The FOMC thus far has been pretty negative on negative interest rates. They would be complex. They're complex in any financial system to implement. But I learned something 12 years ago, which is regarding central banks, which in extremis, if it's needed, if it's legal, you don't never say never. And so is that on the table? I don't know, obviously, but I wouldn't be surprised if there isn't at least someone thinking about it carefully. The when, you'd like to get some sense of whether the economy is leveling off after that terrible step off the cliff that I showed everyone earlier. And if it is that the time that you need to do? If it's not, because the shutdowns are continuing, then almost for certain you have to do more.
Okay.
If it levels off, can you wait a bit? Perhaps.
Okay. Well, that's interesting, because that's actually how Jay Powell sounded to a certain extent, didn't he? I'd like you guys both, I know, and especially for you, Nakamura-san, you don't want to talk to, I want to ask a question about the ECB. That's why I'm sort of stumbling around here, because they didn't increase the pandemic purchase program, but they did cut the rates on the TRLTOs, and then they put in the Peltro, so they've got all kinds of cheaper financing. And for you, this is the same question for you, Patricia. In terms of the efficacy, in terms of how that fits into what broadly, what the BOJ is dealing with, what the Fed is dealing with, what do you see in this step that is going to work? What do you see as the difficulties in taking this kind of step? And let's start with you, Nakamura-san, as somebody who's been plying this trade for many years.
Well, each central bank has the policy tools pretty much based on the assessment of each financial systems and the financial environment of each countries. Mm-hmm. Japan is the bank-based financial system. So in order to stimulate the economy and help the financing, the corporate sector and the household, it's better to use the banking system rather than the market basis. Although we step in the market financing by purchasing the corporate bonds and the commercial papers and so forth. But the banking system is a critical one. And so that's why we set up several funding programs to provide the back financing to the cheap money to and also incentive to the private banks to provide loans to the private sector. Maybe I think the European system is pretty similar to Japan. It's a banking central system, and so encouraging the banking lending is the important steps. As Trish said, the US is more market-oriented financial system. So working on the various asset might be a much better for the working for the financial system.
So, Trish, then what about the ECB and what they're doing? And of course, what Christine Lagarde had her version, she echoed Governor Croda, she echoed Chair Powell. You know, the ECB going to do whatever is needed.
So, so yes, and so they certainly have given every indication that they're going to. One important point, I think, is that the similarities here in a couple of instances are interesting. For example, the targeted LTROs. Putting their price at certainly not a penalty rate, maybe even a subsidization rate, tells you that, first of all, moral hazard is not at top of mind in this crisis, which is absolutely correct for the record. That the amount of risk that the central bank is willing to take is higher than normal. I think that's really consistent across the different central banks, the various central banks, and the ECB has basically said the same thing. And third, that the target here is to go through the banking system. The banking systems are stable, if not healthy, and get to the parts of the economy that really need the credit. And if we have to kind of subsidize the financial system to do that, maybe we'll do it. Now, what's interesting is the Federal Reserve's proposed programs, the actual lending terms there are, at least to corporates and the small and medium-sized businesses, are not at particularly concessionary rates. So that's a contrast, I think, between what the ECB is doing and what the Federal Reserve is doing. But the rest of the lending to municipals, to the PPP loans, to the very small businesses, those are very, of course, that's a fiscal policy program, not a Fed program, are very concessionary. So I think there's a little contrast there. The last piece I think that really matters, though, is the sort of quasi-fiscal cooperation, whether you like it or don't, between the central bank and the government is really not possible for the ECB for the obvious reasons. And I think that is in that regard, that if you think that's a helpful component to what has been going on with the Bank of Japan and the Federal Reserve in this particular unique situation, then that's not something that the ECB, that sort of fiscal risk sharing piece, is really not possible.
Okay. I want to get into a couple of questions from the audience. And in fact, I think this is a nice broad one that a lot of people have been asking since all these aggressive programs started. It is central banks can provide nearly unlimited liquidity, but how much can they offset the risk of business failure or personal bankruptcy? In the sharp, deep recession of the pandemic, do we have to worry about that? And on this one, let's go first to you, Patricia, and then go to Nakamura-san.
Absolutely. A central bank's tools here are traditional tools. Liquidity, monetary policy are not directly going to be able to stave off bankruptcy and so forth. The credit lending programs, these targeted credit lending programs, which can only be done with fiscal backstop in the United States, can help in that direction, but again, only help. The way that you truly stave off massive drops in income, large increases in unemployment, large-scale bankruptcies, in this particular case, is mostly fiscal policy. And while some of that fiscal policy being used to backstop lending by the central bank can be helpful, that is only going to be part of the answer. It can't be the whole answer. I completely agree.
Yeah, I agree with Trish. And at this moment, we have seen the huge drop in the cash flows of the corporations, even the household, and we need to assist their financing anyway. But both central banks and the government needed to work together to help. But as for the central banks, lending is the main tools, and giving money is the government job. So we need to collaborate together to assist the various needs of the money of the private sector.
Okay. Well, and Nakamura-san, in that regard, I mean, the BOJ obviously has bought a lot of bonds. You've got you've got that massive balance sheet relative to GDP, taking more stuff. You've been buying the ETFs BOJ has for some time now, and I know that policy was adjusted this week to change some specifics and rebalance some of the purchase. But so many things. In fact, the BOJ in some ways has been the central bank innovator and disruptor, right? Leading on some things like yield curve control, right? But I guess what a lot of people are wondering is, does this mean then all the more that if more needs to be done in Japan, it's going to have to come more from the government, which has this tighter link to the banking system, which has the ability to spend money? Is that what's going to have to be done? It will be a BOJ willingness to do more, be fine, but really the fiscal side, the government side, has to be there in greater measures.
I guess it crucially depends on how things unfold in future, right? If the private sector needs a financing, then the BOJ have a much more significant load to provide more money or liquidity. And if needs the more, the actual subsidies or any help at the credit side, maybe government has a more role to provide the assistance to the private economy. It crucially depends on the situation. I guess the limit of the balance sheet or central banks, I guess we could do more if needed. And based on our experience over the 2 or 3 decades of the unconventional monetary policy measures, if you do those measures with the careful calibration, we don't see we could minimize the side effects and could get the positive side. But it requires the true assessment of the economy and the financial system, and to see what is needed for the policy measures and so forth. So that's crucially depends on the future developments.
Okay. There's a couple of questions, and I'll sort of put both of them in front of you guys. One is, should central banks assume credit risk in fighting the economic fallout from a crisis? That's the broad, very simple one, okay? A little more here to this one. When central banks take on risky assets, ought they not to have full credit protection from the Treasury Department or, say, from the Ministry of Finance? So, Trish, why don't you jump in on that one first?
So I'm actually going to start with the second one first, because it's an interesting individual case. The one central bank that I know that has followed that or has received that sort of indemnification is actually the Bank of England from the UK government, and full indemnification. That is not what the Federal Reserve has received from the Treasury Department. So let me talk about this in a very Fed-centric context. The Federal Reserve can take risk. They take risk whenever they do lender of last resort. But the risk that they can take is extremely limited, and it's limited by law. First of all, they can't buy risky assets at all. They can. The only way that they are doing the municipal and corporate facilities that they're planning is because the first loss piece is being taken by the U.S. taxpayer. So the structure in the U.S. is for those facilities is not a complete guarantee. It is that the Fed needs to be, and I quote, secured to its satisfaction, which usually means it needs both collateral and a solvent counterparty. And it can't do those for all of these special facilities unless they have, in this case, U.S. taxpayer backstops to do it. So it's not that the Fed's taking no risk, and it always takes some. It takes some when it lends to banks every day. But in this particular case, it couldn't do it. And that's a legal restriction in the US. Maybe it's a safe one, frankly, in some ways, if you think there should be a limit to how much risk central banks can take. But it's also not full indemnification, and no one ever expects that, at least in the Federal Reserve's case, that they would be fully indemnified.
Okay.
Okay, my turn. Okay, regarding the credit risks, the lending from the BOJ to the private sector is fully covered by the collateral, and there's a level of credit risks. And in Japan, we have credit guarantee programs, and also we have government financial institutions which provide the emergency assistance lending to the private sector with the concessional terms and with some credit guarantees. And BOJ has the providing the back financing to the financial sector with a cheaper price. So regarding the credit facilities or lending programs, we have a pretty much minimal credit risks. Regarding the asset purchases, if there's a loss, that is entirely incurred by the BOJ for sure. That's why when we start the asset purchase program, we ask the Ministry of Finance for the permission to engage in this program. If the BOJ suffer losses of this asset purchases, in that case, the BOJ profit will decline, and in that case, the profit transfer to the government will be declined. Ultimately, it is a kind of a fiscal cost. So that's the reality. So in the end, well, the BOJ profit is a part of the source of the government revenue. So it is ultimately the implication for the taxpayers' money.
Yeah, so let me step in as a moderator, emergency. Let me go back to the negative interest rate. That why is Federal Reserve and BOJ so negative about deepening the negative interest rate?
Trish, please.
So I'm not completely sure, but I do know there are a couple of reasons, and one of them has to do with the complexity of implementation of negative rates. On one level, you would think, well, a financial system that's more market-based might be able to handle negative rates somewhat more easily. But the difficulty in the United States is that the retail part of the financial system that is market-based rather as opposed to bank-based. Because we know the retail, meaning small businesses and households, reluctance to directly face negative interest rates is very high. And the classic example of this in the United States are money market mutual funds, which is, there would need to be some pretty substantial changes in order for money market mutual funds to actually be allowed to give negative rates, or there might be, frankly, a large-scale abandonment, particularly if banks were still offering zero. And that's not an insignificant structural change for the United States to figure out how to handle. And I think at least some of the reluctance may be due to that. There may be other reasons as well, and the effectiveness of the perceived relative effectiveness of QE in the United States. It wasn't felt really necessary in the last crisis. So I think the question will become, is if it appears much more necessary this time, will the structural hurdles be able to be overcome or not? Not overnight, let me be clear. No country has implemented negative rates without some structural changes first. But are they insurmountable? My personal opinion is no, they're not. And it's an option that could be on the table.
Interesting. Koji?
Okay, I don't think the BOJ is negative about the negative interest rate policy, because we are implementing a negative interest policy right now. And when we introduced the negative interest policy first time, we see the huge drop in the longer term interest rates. That is the benefit of the negative interest rates. Negative interest rates provide the huge downward pressure on the long term interest, which could be very stimulative for the real economy. So that's the pros. But there's a cons, right? Negative interest rates charge the cost of the financial institutions. So there's a balance between the pros and cons every time. So at this moment, it is important to encourage the bank lending to the private sector. That's the first priority. And so that's why we expand the lending programs and also the asset purchases. That's the first line of defense. In the future, it depends on it depends on the financial markets development. if things are going bad, and if needed, we could do more regarding the negative interest policy.
Yeah, but I remember that when the BOJ introduced the negative interest rate on the reserves, new reserves, incremental reserves coming into the BOJ, there's screams from the financial institutions that somehow they lost the slope of the yield curve. That's my interpretation is that's triggered YCC later. But still, they're very cautious. They means the commercial banks and financial institutions are very reluctant to accept this negative interest rate as a policy tool. Am I wrong, Koji?
Yeah, I'm sure. I know that, and because the negative interest rate has the provide a negative impact on the financial institution for sure. But the lower yield curve has the huge positive impact on the real economy through the stimulating the consumption, housing investment, and the capex and so forth. That is the important factor. What we need is to bring the economy back to the normal level. In order to do that, negative interest rate might be the positive effect. And at this conjuncture, we need to provide the liquidity more rather than the changing the interest rates. Keeping the low interest rate is the good one, but it's more important for the low interest rate environment in the recovery phase rather than current phase. So, the changing the interest rate is not the good time for now, and now we can concentrate on corporate financing, household financing.
So how possible or probable that this liquidity crisis we think may turn into the solvency crisis, that you couldn't stop those businesses coming back? Sorry, Kathleen,
No, this is so great because I wanted to tell the audience, Taka Ito it's so nice to have him join the conversation. I think the central bank gods wanted this to happen, because to have him with us and not be a participant, I think would be a shame. So I'm just really glad to include you now as well. So go ahead and ask the question you're going to ask. And I'm sorry, I'm in the Poconos, and we've had some rain and power surges out here. So anyway, it's great to see you. So please continue, Taka.
So the question I just asked is this probability of the liquidity crisis, which we think it is, turns into the solvency crisis. Trish?
So are you talking on financial terms or in real economy terms?
Real economy.
Real
economy spill over to financial.
So financial and then back again. Oh, I'm very glad that we walked into this crisis with a relatively strong financial and banking system, both globally and in the United States. Very glad, because I think the losses that financial institutions are going to face 6 months from now are going to be very, very sizable. The good news is they have large capital cushions. In addition, if these bridging facilities, particularly the fiscal bridging, the transfer payments to households and small firms, and at least some of the credit programs, the credit lending programs, can keep a floor underneath the real economy, they're still going to be, sadly, I mean, Jay Powell's right, it's heartbreaking. There's going to be a huge amount of unemployment. There's going to be a massive amount of defaults. It's terrible, and bankruptcies. But if you can keep a floor under that so that it's here and not way down here.
You lost something.
Then, I know, don't move your hands around on Zoom. It's a lesson here. Then the banking system and the financial system has a chance to stay fairly stable and do its job effectively of providing credit and intermediating in the financial system. That's the baseline. If it's a lot worse than that, or we're very wrong, or the virus is just incredibly persistent, and that's not something that any of us, that I at least am at all qualified to judge, then it could be worse.
Okay. Koji, shortly, then.
Yeah, I agree with Trish that the we are pretty fortunate that you have a very resilient financial system, well capitalized, and now banking system is providing the credit thanks to this high level of capital. But I agree that there's a risk that if the economy is shut down for a long time, more than we expected, then the liquidity program turned out to be a solvency problem. That is disastrous. And we need to stop that. And so first we needed to see the resilience of financial system at this conjuncture. That's the important fact that BOJ is actually conducted top-down stress testing in April in the financial system report. Our stress scenario is pretty much in line with the previous global financial crisis, which is pretty large negative shocks. And we find that even after we hit the negative shocks, like the global financial crisis, Japanese financial system is still resilient. Although there's a huge diversity among the financial institutions. Some weaker banks have some problems, and stronger banks will be okay. But it's not a full-blown up financial crisis. If we implement the similar scenarios like the global financial crisis, if the shocks might be much bigger this time rather than the financial crisis, that might be a problematic for sure. Okay. But we don't know for that. But it crucially depends on how coronavirus will be contained.
Okay, I want to follow up. I want a different question from the audience. This is about the BOJ, very specifically. Besides unlimited bond buying, shouldn't the BOJ be more aggressive in buying ETFs and more directly stakes in global diversified Japanese conglomerates like Sony, Panasonic, Toyota, SoftBank as a backstop by sending a message that the BOJ will act more aggressively on the equity side? This could trigger an increase in investments versus savings amongst its citizens and attract foreign investors. What do you think?
Well, regarding the ETF stock purchases, we increased the amount of the purchase pace of the ETFs in March. And we have already increased the amount of stock purchases. That's one answer. The second one is that whether the BOJ should buy the individual stocks or not, we purchase the ETFs. It's a market stimulative package and not going into the individual stocks. So that's not the BOJ's job, I guess. It's a matter of the other agencies if help is needed, like the United States.
Okay, Trish, question specifically to the U.S. in fact, because it seems to me so far, becoming one of the hardest hit countries. 2/3 of GDP is consumer spending in the United States. Will consumer spending come back as before after the reopening of the economy? If not, how much of it will come back in the fall of this year? Of course, that person is assuming in that question that the reopenings will be happening by fall, but it's a question, especially since people talk about changes in behavior. People will be reluctant to spend, they'll save more, etc.
I actually think that's quite possible, and it's one of the reasons that I think even if the reopening is relatively steady, not all or nothing that everything opens up at once. I think we've learned enough in the last few weeks to know that seems pretty unlikely. But if it is done slowly and carefully, and it does indeed start sometime in the summer and go on into the fall, I do think the recovery in consumer spending is going to be very slow and steady. And it's one reason that I'm very dubious about a V. But of course, the uncertainty about this virus and about how it's going, particularly should there be second and third waves, and how that will impact consumer spending, and it's an IT and uncertainty. We really don't know. And while businesses and households may respond to policy impacts and to confidence effects and to the actions of central banks and finance ministries, viruses don't. And that's a quote from a former colleague of mine. They're not going to respond to those confidence impacts. They're going to do what they do. And if that happens again, it is quite possible that the path for consumer spending coming back may be even slower than, well, certainly slower than any of us would like.
There's a couple of questions here about inflation, and of course it makes me chuckle in a way because we know so many central banks in the developed world have been trying to boost inflation. One of them is worried about monetary expansion already starting from a position of excess liquidity. So is this going to cause global inflation? Another one, very concerned about the long-term risk of hyperinflation, and because of these, all the government spending and all this money and liquidity being provided, will that be what we see? And I guess we can start with you, Nakamura-san. We'll hear from you too as well, Trish, because the BOJ has been trying a long time, and at the meeting this week, it seems that Governor Crota said, basically he acknowledged that the 2% target in this environment now is, it's not something he's focused on. It's not going to be part of his legacy when and if he steps down from the BOJ at some point.
Well, BOJ has actively engaged in the monetary policy in order to bring the inflation back to the normal level. 4 years, it takes a long time. And, at this juncture, this coronavirus shocks provide the inflationary or deflationary is a question for maybe in the short term. I guess as I shown in my slide, we think that the inflation might be muted, and so there's a clearly downward pressure on the prices for the time being. We see the similar situation when we have a big earthquake in Japan at the time. That is also the huge supply shock, and but the price is not moved so much because the inflation expectation was stable at the time. So at this time, it is important to make the inflation expectation to be stable, and to do that, the central banks should be active to the stimulating economy and bring the back inflation rate to the target level. In the longer run, there's always argument that there is a possibility of hyperinflation rate because of the fiscal debt is high and the central bank balance sheet is high and so forth. But we haven't seen any symptoms of the such a risk in Japan, as you can see in it right now. The important thing is that the central banks should act pretty much in line with the inflation targeting framework, and the government should engage in the fiscal sustainability. So those two things are very important for the longer term perspective in order to stop the hyperinflation going unfold.
So Trish?
So I agree with Koji. There have been, my personal view about the current situation is certainly an aggregate supply shock, but the drop in aggregate demand has been much, much, much bigger and will continue to be, which means it's basically going to put downward pressure on inflation, if anything. But looking at the longer term perspective, one of the puzzles of the last 10 years has been why the advanced economies who have provided all of this incredible liquidity and monetization have not been able to get their inflation rates up to their target levels as quickly or as often as they would like. I'm afraid that I agree with Koji. I don't think this is going to go away in the short run. I'm guessing that the downward pressure on prices will be on inflation will be bigger in the short run. Whether they come roaring back or not is a very interesting and big question, particularly since nearly every economy who can afford and has any fiscal space and has the ability to borrow is going to need and want to do massive fiscal expansion over the course of the next year or so. Figuring out how, and that's exactly what they should be doing. Let me be clear. This is not the time to worry about fiscal deficits, not right now. But in a year and a half from now, 2 years from now, who knows when the right timing is. But when things are back to a normal, even keel, how do you get your fiscal house back in order? Because if you don't, I think that's the point at which the possibility, even if it's still remote, but the possibility of more inflation pressures could arise.
Okay, just really quickly, because we got to wrap it up. Very brief answers. I just think this is on everybody's mind. Central bank independence, what is the future? Is it jeopardized now as central banks take on more and more steps, are so aggressive, or is there a way through this? We'll start with you, Nakamura-san, and we'll finish with you, Trish. Keep your answers brief or I'm going to get in trouble.
Well, the central bank independence is secured because it is stipulated in the law, and we do along with the law. And we have also the framework of the agreement with the government. So I think as long as we can secure our activity and explain to the public, and the public understands the situation, I think that the independence will be secured.
Trish?
Yes, I think the checks and balances in the U.S. Are different, but equally valid. One is that, first of all, this really close cooperation between Treasury and the Fed is only going to be there as long as the appropriations are there and as long as the equity cushion is there. And after that, it's the Fed's decision about how to do these things. That's not going to be there forever. Not only that, the reluctance of the politicians in the United States to have the Federal Reserve do these sorts of things is very high. So as I take it as that makes me have some confidence. But it is true that in all out fiscal monetary coordination, a la the Second World War, it took quite a few years, 6 to be precise, till 1951, until the Fed Treasury Accord that established that the central bank was responsible for these two things. So is it going to happen instantaneously? I hope so, because of the temporary nature of the structures created this time. But the reality we'll see. Perhaps it will take a little longer.
Okay. Well, I want to thank both of our esteemed panelists, Koji Nakamura, Patricia Mosser, Bank of Japan, Columbia University, of course, Professor Mosser, formerly the Federal Reserve, New York Fed that is. And I want to also thank Takatoshi Ito, Columbia University professor, who stepped in so ably when my system just paused for a moment. And thank all of you for joining us. Japan Society, thank you for inviting me to be the moderator. Terrific event, terrific questions raised, answered by our panelists at a time when I think these are the kinds of things that are on everybody's mind. And we'll look forward to doing this again. So thank you for joining us today.
Thank you.
Thank you.